In Singapore's ever-competitive housing market, some people ask if buying an old resale HDB is worth it. These flats offer undeniable advantages like affordability and location. However, their old age presents its own challenges as well. So, let's discuss what are the pros and cons of buying an older HDB flat. Let's start with the positives first. The first benefit is a lower price quantum. In general, the price of a leasehold flat tends to decrease in value as the remaining lease duration becomes shorter compared to a similar flat with a longer lease balance. This is also known as lease decay. For 99-year leasehold properties, the property and land value will eventually fall to zero and the land will be returned to the state upon its lease expiration. But because of this lease decay as well, HDB flats that have around 50 years or less of lease balance have transacted at around half of the price of flats with over 90 years of lease balance left. So, if you are not buying BTO but have a limited budget, these older flats can be a more affordable alternative. The second benefit is you'll save more on financing costs. As most people need to borrow money and get financing to buy a house, a lower borrowed amount means that you would also save more on the interest payments. This could be useful if you are starting a family or reaching retirement age, as it could allow us to have more cash and CPF savings, which we could then use for immediate needs or for retirement. Furthermore, you can also avoid the asset-rich cash poor syndrome, especially if you intend to live out the rest of your life in the same flat. The third benefit is potentially higher rental yields. Why do I say this? Well, if you are buying a flat with the intention of renting it out after MOP or just start renting out rooms right away, a tenant doesn't really care how long is the balance lease of flat. Renters typically only care about the location, the condition of the flat, and the rental price. So, if you buy an older HDB that is in a good location, intend to live out the rest of your lives in the same flat, do some basic renovation to make it livable, you stand a chance to rent it out at a similar price to other newer flats in the same neighborhood. This makes your rental yield higher considering the relatively low purchase price. Another benefit of an older flat is some are larger than their younger counterparts. You see, in the past, the focus of HDB flats was on providing affordable housing for a growing population. This often meant prioritizing larger living spaces, but over time, with land scarcity becoming a bigger concern, the government shifted its focus towards maximizing the number of units built on available land. This resulted in a decrease in the average floor area of newer flats. While there aren't official statistics, some anecdotal evidence strongly suggests that older HDB flats do tend to be larger than their newer counterparts. For example, 5-room flats built before the year 2000 are typically 123 square meters, whereas those built after the year 2000 are typically around 110 square meters. There are also other flat types that are no longer offered by HDB, such as the maisonettes or double-story units, which of course offers a bigger living space compared to standard apartments. Last but not least, I think location is also a strong reason why many people consider an older flat. There are conveniences that come with living in a mature estate. It's easy to get what you need, and it's a shorter commute to work, etc. Now let's talk about the downsides of purchasing an older HDB flat. The first downside is CPF limitation. If you are planning to use some of your CPF to buy an older HDB with less than 60 years remaining on the lease, then you need to consider CPF limitations. This is because you can only use the full CPF amount if the remaining lease can cover the youngest buyer until the age of 95. If not, then you can only use a prorated amount. For example, if you are 35 years old and the flat you wish to purchase was built in 1977, your CPF usage is prorated since the remaining lease of 56 years will only cover the buyer until the age of 91 years. To know the actual amount of CPF you can utilize, you can just use the CPF calculator on the CPF website. The second downside is you can't borrow as much for older flat. Banks won't loan money as much if you are buying an older flat compared to if you are buying a newer flat. You see, there's this limit called LTV or loan to value. This is basically the maximum amount the bank can loan you. However, the LTV limit is lower if your loan tenure exceeds 25 years for HDB flats or when the loan period goes beyond your age of 65. To make it worse, most banks prefer to be prudent and just reduce the LTV for older flats in general. If you can't borrow as much, that means you need to have more cash for the down payment. So this is definitely something that you need to consider. The next downside of an older flat is that generally it will cost more to renovate them. First of all, older flats have accumulated wear and tear over time. Usually, there are hidden issues such as plumbing leaks or outdated electrical wiring that might only be discovered during demolition. This can lead you to additional unexpected repair costs. Besides, replacing old floor tiles, kitchen and bathrooms can get really expensive. Demolition and disposal also comes at a cost. Compare this with newly MOP flats where a basic repainting will do and you can just move in. The next downside is kinda obvious, but I should still put it here, which is that it's going to be very difficult to sell your flat. As any HDB flat's value will essentially turn to zero when the lease is finished, nobody wants to hold a falling knife. Even if you renovate the inside of the flat until very nice, the aging estate conditions typically deteriorate over time. This may negatively affect your resale value. Your pool of potential buyers will be super niche and limited when you plan to sell. This might mean it can take a very long time to sell, or you need to lower the asking price, or the flat might not get sold at all. The next downside is that you may not be able to participate in the HDB lease buyback scheme. You see, there's this scheme for seniors where they can sell back part of the remaining lease to HDB if they don't need it while still living in the flat. This is a useful option if, let's say, you don't have any offspring or simply don't want to give your flat to the next generation, because you can somewhat unlock the asset value of your flat without moving out. However, the minimum conditions to participate in the HDB lease buyback scheme are having a remaining lease of 20 years and being above the age of 65. So, if you are in your 30s and want to buy an older flat with less than 50 years of lease, then mathematically you just can't meet the criteria for the scheme. The next downside is that older flats have a risk of being taken back by the government under SURS or Selective en bloc redevelopment scheme. The risk is kinda low nowadays, but it's not equal to zero. If you just bought and renovated the flat, you might not be happy if kena en bloc. Yes, the government will offer a compensation amount, but you might think it's too low. So, in summary, is it okay to buy older resale flats? Well, it depends on your situation and the goal you want to achieve. If you just want an affordable place to stay that is in a strategic location and you are not planning to ever sell it off, then older flats can be a good option. But if you have the inkling to someday move up the property ladder, an older resale flat is not a good stepping stone. Buying an older resale flat does limit your retirement options. If you expect to see a handsome profit after flipping, BTO still gives you the best chance for that. Don't forget to like and subscribe, and I'll see you in my next video. Bye bye!